Welcome back to Iron Financial, the only place dedicated to stress testing the market to help you forge a stronger portfolio. Today, we are putting Wendy's on the anvil. They just dropped an earnings report that sent shockwaves, and frankly, it looks brutal. So we're going to hammer on the fundamentals and see if this company is building a solid foundation for a turnaround, or if this is a value trap with a cracked foundation just waiting to collapse.
Right. I mean, everyone knows this logo. Everyone knows the Frosty. It's a classic American brand. But that's the facade. What we care about is the financial structure holding it up. And from where I'm sitting, it looks like there's some serious structural decay behind that friendly face. The question is, how deep do the cracks go?
Let's get right to it. This is the number that blew a hole in the wall. A negative 11.3% drop in U.S. same-restaurant sales in a single quarter. Let's be crystal clear about what this means. This isn't about opening or closing stores. This means the existing, established restaurants, the core of their business, are bringing in dramatically less money. This is a massive crack, and it goes right to the heart of their operation. And that sets up the entire thesis for today's analysis. Is this company simply cracking under the immense pressure of a tough market, with the structure failing? Or is this a controlled demolition? Are they tearing down the weak parts to rebuild something stronger for the long haul? That's what we have to figure out. Is this a teardown or a rebuild? Because your portfolio can't afford to get caught in the wrong one.
Okay, here's our blueprint for the analysis. First, we're going straight to the financial damage report to assess the scope of the problem. Then, we'll see if we can find any silver linings, any load-bearing walls still standing. After that, we'll scrutinize their so-called Project Fresh blueprint for a rebuild. Then, the real gut check. We'll see what their own forecast for 2026 says. And finally, we deliver the Iron Financial verdict. Opportunity or a trap waiting to spring.
All right, let's get into it. The financial damage report. Enough with the marketing, enough with the brand talk. It's time to look at the cold, hard numbers and assess just how bad this structural decay really is. I want to see the receipts.
And the numbers do not lie. Look at this Q4 performance. This isn't just one weak spot. The whole structure is groaning. Global system-wide sales dropped 8.3%. That's every Wendy's on the planet combined. But zero in on the main engine, U.S. system-wide sales, down a staggering 10.5%. Their home turf, their most critical market, is where they are getting hit the hardest. The company's main engine is sputtering, and it's sputtering badly.
Yeah, and don't let anyone tell you this was just one bad quarter. That's a classic excuse. Zoom out and look at the whole year. For all of 2025, U.S. same-restaurant sales were down 5.6%. This isn't a sudden storm that just rolled in. This is a slow, grinding erosion that's been happening for 12 straight months. That's not a blip. That's a trend, and it's a deeply negative one. This table here, this is what really puts the nails in the coffin for 2025. It shows the velocity of the decline. Look at 2024. The company was growing. Not spectacularly, but it was solid. Global sales up 3.1%, U.S. sales up a respectable 1.4%. Now, look right next door at 2025. It's a complete violent reversal. Global sales went from +3 to -3.5. And in the US, their bread and butter, they went from positive growth to a negative 5.6%. That is a 7-point swing to the downside in their most important market. The only green on this entire chart is net new restaurants, and we'll talk about that in a second.
And this weakness at the top line is bleeding straight to the bottom line. It's inevitable. Look at the adjusted EBITDA, which is our best proxy for a company's raw operating cash flow. In 2024, they generated $543.6 million. Fast forward to 2025, and that number has dropped to $522.4 million. That's over $21 million of core profitability that has just vanished into thin air. It's simple mechanics. You sell fewer burgers, you make less money. The financial consequence is direct, and it is severe.
Okay, the damage report is bleak. I get it. The foundation is cracked. The walls are buckling. But in any crumbling structure, you have to look for the load-bearing walls. Is there anything in this business that isn't crumbling under the pressure? Is there any part of this data that's still holding the roof up?
You have to look hard, but we did find a few solid beams in the wreckage. First, the international business is a legitimate bright spot. Full-year system-wide sales grew a very healthy 8.1%. This is where those new restaurants are coming from. 121 of the 157 new builds were international. That's a clear strategic push. Second, their digital game is strong. 20% of all U.S. sales now come through digital channels, which is an all-time high. And finally, for what it's worth, they're still returning cash to shareholders. So yes, there are a few pockets of strength.
But let's put this in perspective. This is absolutely critical.
Yes, international grew at 8.1%, and that's great. But look at the scale here. The U.S. business, which is the massive core part of their revenue, shrank by 5.2%. So the real question is, can this small, fast-growing international boat tow the giant, sinking U.S. battleship? Right now, it looks like they're trying to bail out the Titanic with a bucket. The math just doesn't work. The weakness in the core is overwhelming the strength on the periphery.
So management isn't blind. They see these numbers. They know they have a problem. In response, they've rolled out this big official turnaround plan called Project Fresh. Now we have to examine this blueprint and decide, is this a legitimate plan to rebuild the company, or is it just rearranging the deck chairs while the ship goes down?
And here's the admission, straight from the top. The chairman says they're dissatisfied. You know what that is? That's the most polite, corporate speak way of saying, we know we're in deep trouble. Acknowledging the problem is step one, fine, but being dissatisfied and having a plan with actual teeth are two very, very different things. Is what follows this statement a real blueprint for creating value or just empty words?
So here it is, the high-level framework for their proposed rebuild. It stands on 4 pillars: brand revitalization, system optimization, operational excellence, and reallocation of capital. I mean, on the surface, this all sounds fine. It sounds correct. They want to refresh the brand, make the whole system run better, improve the restaurants, and spend their money smarter. Who wouldn't want to do that?
But this is where the skepticism has to kick in. You dig into the actual actions, and what do you find? Step 1, hire a consultant. Okay. Step 2, enhance training. Step 3, more support for franchisees. Step 4, better tech. I'm sorry, but this is the most generic corporate turnaround 101 playbook I've ever seen. Where is the game changer? How is enhanced training going to fix an 11% sales decline? Will a new marketing slogan from a consultant really bring people back into the stores? This feels like checking boxes, not making bold, necessary moves.
All right, this is the ultimate reality check. A company can say whatever it wants about its grand plans, but its own financial forecast, its guidance, tells you what they actually believe is going to happen. This is where the rubber meets the road. Let's see if management's own outlook for 2026 inspires any confidence in Project Fresh.
And here it is. This is probably the most damning slide of the whole presentation. After a terrible 2025, what does management expect for 2026, the first full year of their big turnaround plan? They are projecting a significant, painful step backward. They're guiding for their core profitability, their EBITDA, to fall even further, down to a range of 460 to 480 million. And look at earnings per share. They expect it to crater, falling to just 56 to 60 cents. Their own numbers say things are going to get worse before they get better, if they get better.
But what about sales? Surely Project Fresh will get sales growing again, right? Wrong. Their official guidance for global system-wide sales growth in 2026 is approximately flat. Just let that sink in for a moment. After a year where sales fell off a cliff, their grand plan for the next year is just to stop falling. This is not a forecast for a turnaround. It's not a forecast for a recovery. It's a forecast for complete stagnation at a much, much lower level of profitability. They're telling you they don't expect to grow.
This chart just sums up the whole bleak picture. Every single critical financial metric that we use to judge the health and strength of a company is pointing in the wrong direction. Adjusted EBITDA, down. Adjusted earnings per share, down. Free cash flow, down. And the best they're hoping for on the top line on sales growth is flat. This is not the picture of a company building a stronger foundation. This is the picture of a company bracing for impact, telling its investors to expect another very, very difficult year.
So there you have it. We've inspected the damage. We've searched for the strong points. We've scrutinized the blueprint. And we've looked at their own forecast. Now it's time to put it all on the scales. It's time for the iron financial verdict. Is this an opportunity or a trap?
The bull case, the argument for buying, really rests on long-term potential. You have solid international growth, a brand that is undeniably powerful and recognized everywhere, and real momentum in digital. The optimist says, look, if Project Fresh can just stabilize the U.S. business, this is a chance to buy a great brand at a cyclical low. But the bear case is rooted in the brutal, present-day reality. The core U.S. business is collapsing. The company's own guidance for the next year is abysmal. There is massive execution risk on a turnaround plan that frankly looks weak. And in the meantime, profitability and cash flow are actively declining. The bull case is a story. The bear case is based on the numbers right in front of us.
So we come back to the final question. Is this a chance to buy steel at a discount, or are you trying to catch a falling knife with no handle?
Here's the iron financial verdict. While the brand has undeniable value and could one day be worth more, the current state of the foundation is simply too weak. The collapsing U.S. sales, combined with a forecast that signals another year of pain, creates a high-risk environment. The turnaround plan lacks a transformative catalyst. For investors looking to forge portfolio strength right now, this looks less like an opportunity and more like a trap. There's simply too much negative momentum and too much structural damage to justify the risk. You don't build a strong portfolio on weak foundations.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.